Good afternoon, everyone, and welcome to the Strategic Financial Leadership Series. We're in part two, Financial Principles Landscape Companies Must Know to Boost Cash Flow. Um, the webinar series we put together with Steve Coffrin and his organization, the Cultivar Group, has had tremendous feedback so far after our first airing last week. The amount of views on the recorded webinar has been great. So thanks everyone for registering and joining us today in our second installment. We do have Steve Coffrin here with us from the Cultivar Group. Steve, thanks for joining us today.
Yeah, you're welcome. Glad to be here.
And so Steve is the founding director of the Cultivar Group, and I'm Joe Salemi, the product marketing manager with Dynascape Software. It's been a really great partnership between our two organizations, and I feel like after such a great response to our webinar series that we're going to have much more in the pipe as we share some ideas. So stay tuned for some more coming after this webinar series. A little bit of housekeeping before we start. All three of these webinars are being recorded, and we're going to be posting them to the Dynascape website. So shortly after we finish today, I'll get the recording prepped and posted to our site, and I'll send out the link to everyone that has registered. We will have time at the end for a Q&A, and there's a question box in your GoToWebinar control panel. So use that question box to type your questions, and I'll be monitoring them so that we can get Steve to do his best to try and provide some answers for us. Steve, I think it's time to hand over the controls and get into the financial principles for today.
Great, that sounds good. Yeah, thank you everybody for participating in this second webinar series. I'm excited to talk to you guys about some very pertinent topics, especially related to boosting cash flow and financial management. So this is a very popular topic among our clients. We also teach some courses about financial management. And I think there's a real gap in the industry. I think if companies can grasp some core financial ideas and concepts, they can really make huge improvements in a business. So I'm excited to share just a few tidbits with you guys today. A little bit about my background. I've been in the industry at a landscape company for 13 years. I've been consulting companies for over a decade. Here's my bio you can read through. But like I've said in the other webinar, or in the first webinar series, is look me up on LinkedIn. You could read through this on your own. But I am a nerd when it comes to accounting and finance. I'll tell you that. I'm the only guy on vacation on a beach in Mexico with a highlighter reading a finance book. My wife thinks I'm absolutely crazy, but you know what? I love this kind of stuff, and this is my passion. So let's hop into it. What is eroding profitability? Okay, so what's eroding profitability, both in our industry and both internally at our companies? And the second part is, what should we do about it? So if we look at the context behind what's going on in our industry and what's eroding profitability, I broke it down in some main categories that I'll just talk about briefly. Some of these I talked about it last week in the emerging technology webinar. So if you weren't a part of that, go back through and review this. Some of this I'll talk about next week in the strategy seminar. But first off, the skilled labor shortage. So we have a labor shortage. The average age of the workers in the construction industry has increased from 36 years old in 1985 up to 43 years old, which we're at today. And in fact, about 50% of our workforce is over 45 years old. So it's actually even higher since 2015, so 45 years old now. So with this labor shortage, our labor costs are increasing, and labor costs are typically the highest expense for companies in the landscape industry. So when labor rates go up, profitability ultimately goes down if we're unable to adjust prices. Also, cyclical demand can destroy profitability. When the economy is good, profits go up. When the economy is bad, obviously it goes down. But there's also the cyclical nature of the industry. For every 3 to 5 years, the industry typically takes a nosedive and hits a recession. So we have to be able to prepare for this. And this is what I'll be talking about next week in the strategy webinar, about how to prepare for cyclical demand. Also, the industry, I mean, if you're in landscape construction or landscape maintenance, it's very capital intensive. So to get a crew out there, to buy a trailer, to buy skidsters, buy trenchers, and so on and so forth, it's very capital intensive, our businesses. So this reduces, I mean, we have the profits, but then we have to reinvest those profits back into the business. Low barriers to entry. So I looked it up. There's over 466,000 registered landscape companies just in the U.S. alone. So this creates tremendous competition. When barriers to entry are low and it's really easy to enter the industry, profitability declines because anybody could actually go out there and get a truck and some equipment, and they could immediately be in business owning a landscape company. So when barriers to entry are regulation increases, and more regulation that we have, the more complexity we have in our organizations, and profitability declines. And then technologies and systems. Companies are innovating, they're adopting and incorporating technologies to become more profitable. And those that are not, those are the ones that are suffering from a profitability standpoint because they're just too antiquated in their processes. That's what I talked about last week. So how people are financing their projects, I'm going to talk about this more in detail next week, but I just want to talk just briefly. I think it's important to understand how people get money to invest in landscaping. So it doesn't just grow on trees. And in fact, if you are in the design build market, especially the high-end market, that's where I used to play, people that were spending $250,000 plus on their landscape, these people are getting cash from other locations rather than just a high salary. Oftentimes they sell a business. Most of our clients came from customers who sold a business or had a liquidity event in their life. Maybe they got some inheritance, but that's where they came up with the money to invest in their business. Also, cash out refinances. You can see the trend, and it's climbing even higher. So we're at record highs as far as cash out refinances. So as interest rates stay low, especially on mortgages, they're low, people refinance their homes, they take money out and they invest in the landscaping. Wealth transfer, savings rates, and then the job recovery market. So any excess and disposable income comes and impacts our profitability. Like I said, next week when I talk about strategy, I'll go into this in more detail. But I want to just paint the picture from a context and background standpoint, what's impacting profitability. Now, when I talk about strategy next week, I'm going to be talking about how we can create plans in order to prevent competition from stealing our profit and cutting into our piece of the pie. Now, when I talk about competition, a lot of times people describe their competition in terms of other firms that are doing the exact same thing. So other landscape companies, so XYZ Landscape, ABC Landscape, so on and so forth. They describe those companies as their competitors. But in fact, there's other external forces and other forms of competition that erode profitability. So if you look at it from a perspective of these different categories, buyer power, when buyer power is high, it erodes our profitability. So when customers are powerful, profitability is eroded. So if you look back at 2005, 2006, that's when I had my landscape business, and we were rocking and rolling. I mean, we were doing some big projects, and we had a lot of power. I mean, just by showing up to bids, we had a competitive advantage because other people weren't showing up. So just by showing up to the bid, we had tremendous bargaining power there. Fast forward to 2009, 2010, when the economy softened, all of a sudden buyers became very powerful, and they were out there soliciting multiple bids and really dominating prices there. So when buyer power is high, profits erode. When competition's high among your peers, profitability decreases as well. So that makes sense. That's pretty obvious. That's the obvious one. Supplier power. When supplier power is high, profitability erodes. Now think about suppliers. Who do you think about when I say the word suppliers? Now probably most people think, oh, our nurseries, our irrigation supply houses, our aggregate vendors. But really, your biggest supplier is your supplier of labor, your employees. So when supplier power is high, it erodes profitability quite a bit. And this is crazy. This is a crazy time across the country. I have clients that tell me that a whole crew, even a crew that's been with them for 10 years, they just turn in the keys and just walk away for a few more bucks an hour. So suppliers are really powerful. Subcontractors and employees are powerful. Threat of new entry, I talked about that. Relatively low capital investments required. I mean, you could start a landscape company and rent your equipment if need be. So when it's easy to enter an industry, profits go down. When it's harder to get into an industry, think about like a Facebook or something where it requires technical expertise or millions and millions of dollars to start a business. Profits are a little bit higher. And then threat of substitutes. When I say substitutes aren't just substitutes for sod, like artificial grass is a substitute for Kentucky bluegrass. I'm not talking about that. I'm talking about substitutes that compete for landscape dollars. So, for example, somebody may have $50,000. Well, a competitor to you is not necessarily ABC Landscaping. A competitor may be a kitchen or a kid's college tuition, right? So those may be other alternative uses of that money, and those are competitors to your project as well. So just things to pay attention to. Now, internally, there's forces of profit erosion. So if you look here on the left-hand side, estimated profit is listed out. So if you are bidding out a job, whether it's a maintenance job, whether it's a construction job, you come up with your cost, you bid it out using a multiple overhead recovery or fixed percentage, whatever it may be, whatever your approach is. You have estimated profit, and then you have erosion that's occurring along the way. And I mentioned this during the first webinar series. You have mistakes, you have non-recoverable change orders, scope creep, rework, discounts, and at the end of the day, you have your actual profit. So the actual profit, the difference between the two is profit erosion. This is the whole idea. The idea here is the first webinar series, implementing technology in order to reduce profit erosion. This webinar series to talk about how do we manage our finances to prevent profit erosion and boost cash flow. And then the next one that I'll be doing, I'll be talking about what are the strategies in order to position ourselves so we can capture the most profit as possible. But companies, they must take a holistic approach. They must look at profits from a comprehensive viewpoint. So in my book, Delivering Value, this is the leadership triangle. In the middle, I have the customer, and then I have the 6 value drivers going around the side. Profit is just one value driver of a business. If you just focus on boosting profit and you ignore the other things, like you ignore your employee training program and retention program, or you ignore the quality of your products and services, or you ignore having a strategic plan, and you become narrowly focused on one of these elements, such as profit, then you don't deliver value to the customer who's at the center, and ultimately, you destroy your business. So the point of this slide is to show you that it has to be in balance. There's 6 value drivers that exist, and then the customer is at the center. And you have to focus on all these value drivers equally or comprehensively in order to create real value. So we'll talk about profit and a little bit more and how that relates to cash flow. So what levers can we pull if we want to boost profits? So let's just say we're below industry average profit. We're competing at 2-3% profit. What should we do, right? And maybe some of you are on this webinar wondering that, and maybe that's why you're participating now. So what can we do? Now, what most companies do is they go through the wrong type of approach. So there's a design build company in Colorado, and they were very successful. They were doing about $15 million a year in profit and profits, or $15 million a year in revenue, sorry. And then they're highly profitable, over 10% profitability. And then over the years, the profit just began to sink year after year after year. And what they ended up doing, they hired a consultant to come in. And I know this because there's several people that worked at the company who are very close to me, and they relayed this story to me. So they hired a consultant, and the consultant came in, and immediately what they did is they started cutting costs. So that's that's what consultants have a bad rap for. They came in and they started cutting costs. So they're cutting operational costs, overhead costs. They were they even fired some of their higher paid employees, which was a huge mistake because those employees were bringing in a bunch of work and a key piece of the business. But they started doing all these weird things, and they ended up destroying employee morale. And a huge chunk of that company, a lot of the key managers and rainmakers, they left the firm and they ended up starting their own landscape company as a result of this consultant. And those who stayed, employee morale was just killed. I mean, they were making cost cuts like putting codes on copy machines so people weren't making excess copies, and just doing ridiculous things that were destroying morale. So really, what I wanted to do is really understand in a quantitative manner what really is the best way to boost profits. So I did a study, and I looked at different landscape companies and came up with this graphic here. So what I looked at is different firms throughout the landscape industry, and if I increased any of these things on the left-hand side by 1% or decreased them, I wanted to see what the impact would be on their profitability. So I ran it through this model and did some research on it, and this is what I came up with. So we'll go through each of these. So if you increase volume, what I mean by that is you just go out and do more sales. If you sell more work, right, you take your company from $5 million a year in revenue to $10 million a year, increase volume. If you do that by every 1% you increase your volume, you could have a 9.6% impact on profitability. That's what this slide's saying. If I decrease my overhead by 1%, 8.6% increase in profitability. Decrease my variable costs, which are my material costs, my equipment maintenance costs, my labor costs, subcontractor costs. If I decrease that by 1%, 9.6% profit change. And then if I increase my price by 1%, I have a 19.2% profit increase. All right, so let's pause here and think about this. Now that you have this slide here, now you know the levers. What is the best approach to boost profitability? Now, all these approaches can be used in tandem. I'm not advocating that you just pick one and only one. So I think it's good to have an efficient company with efficient overhead. I think it's good to watch your variable cost and be sensitive to those different things. But the point here is that so many companies tackle cost cutting instead of increasing price. So if you increase price just by 1%, so I'm talking on a $1,000 bid, you add $10, you can have a 19.2% increase in your bottom line. Pretty substantial. That's why last week when I was talking about technology, I think it's absolutely crazy that there's companies out there that refuse to digitize, right? Go to more digital processes and use digital tools like web-based platforms for managing their company and for estimating and designing, when there is so much opportunity for improvement. So rather they'd go back and try to cut their costs. You go back and beat up your vendors for lower square foot prices on sod, or lower plant material costs, or beat up your irrigation supplier, whatever it may be. But you beat up your suppliers too much, and then when it comes time to needing a favor, they will definitely not be there to help you out. And the whole tactics that irrigation companies do, I remember our suppliers would come in, and a new supplier would come in and say, "Hey, let me give you some really aggressive pricing. I want to win your business." So they'd come in and give us a price list, and on the price list they'd have like some Rainbird 1804s listed out, some nozzles, the backflow preventers, the timers, and all the key things that we'd use. They'd have really good prices. Well, that's fine, but then they just hide the prices in the fittings and crimp clamps and whatever, and make up the margins there. So the point is that you have to be careful when you go into a cost-cutting strategy, because you may actually be doing more damage than good. So let's talk about pricing. There's a difference between estimating and pricing. Estimating is just a matter of taking all your estimated costs, your anticipated costs and productions, and then assigning overhead costs and then profit, and then giving it to the customer. That's estimating, right? And there's so many estimating approaches, but we all know the common ones. multiple overhead recovery. We know you could have just a fixed markup. You could just take all your costs, mark them up X%, and not do multiple overhead recovery. You can do some kind of a factor like materials times 3 or some goofy things like that. That's estimating. Pricing, though, is taking your estimate and saying, okay, this is what it should be, but then pricing in different, pricing your services based on different factors. So here's different pricing strategies. So when it comes to raising prices and changing your pricing structure, you can first just take a unit price approach, which I think is a horrible approach. So if you're using unit pricing, you are leaving tons of money on the table and probably making some big mistakes along the way. Is it the easiest approach? Yes, of course it is. But on smaller jobs, if you're using unit pricing, you're probably missing out on a lot of upfront costs like mobilization, design, administrative costs. If you're doing big jobs and you're using unit pricing, you're probably losing big jobs because you're not incorporating economies of scale. So unit pricing is not a good strategy. Cost plus, I talked about that. That's just a matter of, here are my costs, and you add a percentage to that. Value-based pricing, though, this is based on perceived value by your customers. So if your customers perceive value, perceive a higher value, the price could be whatever that value is. So just because your estimating software tells you that it should be $1,000, there may be more perceived value, and you may be able to charge $1,500. So that's what I'm getting at here. Promotional pricing is you go in there, you reduce the price to increase sales. There's premium pricing, penetration, bundle, psychological. These are all different tactics and different strategies of pricing. This is a whole full-day workshop, pricing and estimating. So what I want to just communicate here is that pricing is different from estimating. Pricing requires strategy. Estimating just requires running the numbers through the system. And there's a big difference between the two. But remember, every 1% increase in your price will equal a 19% increase on average in profit. So if you do not have an estimating system, okay, if you're using Excel, if you're not even using Excel and you're just using like numbers out of your head, please look into changing this approach, because just by doing this, you can have a huge impact on your business. And be careful by the different approaches out there too. I put on a seminar earlier this winter and I did a test. I wanted to see really what was the difference between all these overhead recovery methods. And I found some interesting things, because there's some assumptions that are out there in the landscape industry of which approach is right. And some of them there's actually very little difference, and some of them are actually causing companies to pick up the wrong type of work, more labor-intensive work versus material-intensive work. So anyways, just be aware of that. That's a whole nother session, though. Determining profit percentage markup, that's going to depend on customer demand. That's going to depend on the environment that we're in. Are we in a strong economy, a weak economy, competition, need, risk, brand? All these different things determine what kind of profit you can achieve on your projects. Cost behavior. So costs, when I talk about cost structure are the variable costs and the fixed costs, or your cost of goods sold and your SG&A or your overhead, that make up the structure of your business. So you may have two different companies out there doing the same exact thing, installing sod, installing water features, doing irrigation systems. But one may be significantly lower in price than the other, but still have higher profits. And the way that they do that is by having a lower cost structure. So cost structure depends on variable costs, fixed costs. You have these semi-fixed costs and mixed costs. Variable costs are easy. Think about an hourly employee. That's just every hour they work. It's a linear progression. Those are variable costs. Fixed costs are salary employees, so maybe like an accounting person or office manager. That's just a fixed salary, irrespective of volume. It's always the same. Mixed costs and semi-fixed costs. Think about a designer who makes a salary plus commission. So you have different costs like that. The key here is to understand what kind of structure your business has as far as costs, and are they variable or are they fixed? Because if you have a lot of fixed cost, when the economy changes, it's very, very hard to be agile and to adjust if your costs are really fixed. And this is really what drives companies out of business. If you have a lot of variable cost, then you can easily scale up or scale down. So anyways, that's enough about cost. So here's probably one of the most important sections that we'll cover today. What is the difference between profit and cash flow? I really want to hash this out. So to put it quite simply, profit measures competitive advantage. Cash flow measures financial health. Let me explain. If industry average profit, let's just say for a certain geography in the landscape construction space, is 6%. Profit, if you look at your net profit as a percentage of revenue, if you have higher than 6% profit, that's good. That means that you have some type of competitive advantage. If you're below that, if you're 3%, 2%, even though you're above break even, you don't have a competitive advantage. And basically, you're just playing to play. And this is where you have to decide, am I in business? Am I just playing to play? Or am I playing to win? If you're a football team, are you just playing to play the game? Or are you playing to win the Super Bowl? That's profit. You're measuring competitive advantage and how you stack up compared to competitors. Cash flow measures financial health. Cash flow measures financial health. Companies can have profit and not have cash flow and be in serious trouble. And in fact, 70% of companies that go bankrupt are profitable when they close their door because they have profit on the books, but they don't manage their cash flow. So what am I talking about here? If I may, I'm going to nerd out for just a few minutes here and talk to you about how to compute cash flow. Okay, so most companies, if you look here, they look at revenue, cost of goods sold. So revenue, those are your sales. Cost of goods sold, these are all the costs that make up, or these are all the costs that you generate in order to produce your revenue. In other words, these are your costs of your sales. So material cost, subcontractors, field labor, equipment maintenance, not the equipment cost, but the equipment maintenance, permits, warranty work, all this stuff goes into cost of goods sold. So you take revenue minus cost of goods sold, you end up with gross margin. Then you end up with, after that, selling, general, and administrative expenses. This is also known as overhead. But your overhead, you need to break up into these three categories: S, G, and A, selling, general, and administrative. I didn't make this up. This is just an accounting practice. By breaking these up, number one, if you break up your selling costs, you'll be able to determine customer acquisition costs and things like I'll be talking about next week. You'll be able to benchmark yourself and see where your overhead is fat or where it is thin and operating well. So you take gross margin minus your overhead, your SG&A, and you end up with EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. This is another way of saying profit. So it's just a nerdy way of saying profit, EBITDA. After EBITDA, you subtract out depreciation and amortization. Depreciation is depreciating tangible assets like trucks, skids, backloaders or backhoes, front end loaders, mowers, trimmers, aerators, all your equipment. Amortization is amortizing intangibles such as computer software and other non-tangible type assets. So you take EBITDA minus depreciation and you end up with EBIT, earnings before interest and tax. From there, you take out taxes. And then you end up with net operating profit after tax, NOPAT. So the top two gray shaded boxes, if you can see that, this is where most companies focus, and this is where most companies stop at profit, net income, NOPAT, whatever you want to call it. This is where most companies stop. Okay. However, below this line, this is really where leaders need to focus. So I always say managers focus up top, leaders focus down below in the last box. So after you have operating profit, you add back depreciation and amortization. You have to subtract out your capital expenditures. This is investments in trucks, in equipment, so on and so forth. This kind of stuff does not show up on your income statement. It shows up on the balance sheet. So you subtract out capital expenditures. And then you subtract out changes in net working capital, which is the difference between your accounts receivable and your accounts payable. Then you end up with free cash flow. So what the heck did I just say? I just totally nerded out and totally just blacked out for a minute. No, I'm just kidding. But what I did is I just took you down from profit to free cash flow. If I just lost you, totally fine. Okay, this is my dirty world. This is where we live at Cultivar. This is the kind of stuff we help clients with. So if you don't understand what I'm saying, that's totally fine. I've spent decades on this. I don't expect you to get it in just 5 minutes. But the takeaway here is, in order to be a sustainable business, in order to mitigate against risks of cyclical changes in our industry, right? In order to protect yourself against risk in going out of business, you have to focus on free cash flow. You don't need to calculate it, but you need to be aware of it. So the key takeaway here is you need to have metrics in your business that monitor free cash flow. You can monitor profit as well, but you have to monitor free cash flow. Monitoring free cash flow does not include logging onto your bank's website and determining whether or not you have a cash balance. That is not free cash flow. That's your cash balance, but that's not the flow of cash. This is absolutely critical, okay, to understand. In addition to free cash flow, you need to have a very simple dashboard to monitor profit. This is going to help you boost your profitability because you're going to be able to pinpoint areas of weakness. I just put up some random metrics. We use dozens of metrics with clients. I just picked out a few. But you should have some kind of dashboard that's really, really easy to understand. And oftentimes I get the question, hey Steve, how much information, financial information, should I be sharing with my team? And I always say, you should share the information with those of your team. Share the information that they can actually impact and influence. There's no sense of showing people everything if they can't influence it. So some people are really private and sensitive about what they show their employees, and that's fine. You don't need to show them the cash flow of the business. You may not even show them the net profit, but you may want to show them gross margin because they control cost of goods sold, or you may show an estimator gross margin because they control the revenue and the sales. The point is that you need to have something really simple that tells a story, and a dashboard like this tells a story. A financial statement, which I'll show you here in a little bit, full of numbers, doesn't tell the story. This right here, you can look at it and say, okay, I definitely get the trend. The line is going up, that's good. Line going down, that's bad. Right? So very, very easy to look at. On a trailing 12-month basis, you have to make sure that all your reports are shown in trailing 12 months. What I mean by that, if you look at the top left graph, revenue trending, that is not March. That's not March's revenue for the month of March. Instead, you need to look at the revenue from March over the last 12 months. So looking at April from the previous year to March of the current year. So each blue bar in this graph represents one full year of data. Then you could really see the trend. If you do it month over month, you get a bunch of weird squiggly lines. It looks like a dinosaur or some kind of dragon. That's because of seasonality. So you eliminate seasonality by doing trailing 12 months. If you have questions about this, please reach out to me afterwards. I'll explain it in more detail, but that's the key. Look at your financial information in trailing 12-month form. Have a dashboard that's really easy to look at where you can say, yes, okay, our labor costs are trending in a good direction. Yes, our sales are increasing month over month on a year-over-year basis. Look at our cash flow here. Our cash flow is trending the right way. So that's the point of that. So what are the 3 core financial statements that you must know? So once again, like I said, I teach 2 programs, really, financial programs to contractors. One is financial related, one's more of a strategic financial leadership academy. In the financial related courses, there's one called Boosting Your Financial IQ. In that, I spend 3 different sessions, okay, and these are almost all-day sessions, half-day to all-day sessions, depending, going over this income statement. So I'm going to try to go over the income statement, the balance sheet, and the cash flow statement in about 5-10 minutes. Okay, so I'm going to go over this kind of fast. But please reach out to me afterwards. If you have any specific questions, happy to help you. But I want to give you at least a taste and understanding what the heck you should be looking after. So the income statement is quite simply, it's a statement that shows net income. Okay, so it starts with revenue, goes down to cost of goods sold, then you get down to operating expenses, and then you have your operating income. You include other things like interest expense or the gain on the sale of a piece of equipment, and then you end up with net income. But this is just the general structure of an income statement. If you look down below, like the operating expenses, how I talked before, most landscape companies that I work with, the first thing we do is we go in and we clean up their chart of accounts. So usually they have all their expenses lumped together. So they don't break it into selling, general, and administrative categories. They just have it all lumped together. And I think it's important to break it out, like I said, to benchmark and really to slice and dice your overhead. So this is a good structure. But basically, the income statement is revenue minus cost of goods sold equals gross margin. Take out your operating expenses and you end up with profit. Okay. Most companies I work with use the income statement and they think this is number 1. However, this is completely backwards, which I'll explain. The next statement is the balance sheet. The balance sheet is probably the most misunderstood financial statement before the cash flow statement. The balance sheet shows current assets, long-term assets, liabilities, and equity. So a lot of things that are outflows of cash are actually on your balance sheet that don't show up on your income statement. That's why you have to understand where things flow. So if you're taking distributions out as an owner, taking money out of the company, that's not showing up on the income statement. So you can be fooling yourself. That's where 70% of companies that go bankrupt are profitable when they close their doors, because on the income statement they show profit, but on the balance sheet they have other things going in and out that aren't showing up on the profit statement, but they're cash flow related, and they kill the business. So it's very important to understand the balance sheet. So current assets, long-term assets, non-current assets, liabilities. Liabilities are debt, right? Liabilities and debt, so money you owe your vendors, the long-term debt that you have on your equipment, so on and so forth. And then you have your stockholders' equity, which makes up your profit and your retained earnings. The cash flow statement here, this is probably the least understood and the least used. So if we were all in a room together, I would say, raise your hand if your company looks at a cash flow statement on a monthly basis. And if I was lucky, I would get one person to raise their hand. So I've done this multiple times at different conferences. One time I had about 100 people in the room, and one person raised their hand that they were actually reviewing the statement of cash flow. So if you don't use a statement of cash flow, totally normal. Acceptable? No. Normal? Yes. So this is one part you need to change. The statement of cash flow is broken up into 3 different categories: operating activities, investing activities, and financing activities. This really shows you how much cash flow you're generating from normal operations, how much cash flow you're investing into the business, and then how much cash flow is coming from financing, like debt and so on and so forth. This all reconciles back to the balance sheet, to your cash flow. I'm not going to go much more into the detail of this, but let me just say this. The most important financial statement that you can review is the statement of cash flow. The second most important financial statement is the balance sheet. And the third most important is the income statement, in those orders. Most people, they look at the income statement first, and that's it. So I challenge you to reverse this. Statement of cash flow, number 1. Balance sheet, number 2. Then look at the income statement. Okay. The next part that I want to talk about is forecasting. So what is forecasting, and what do most companies do to get this Most forecasting looks like this. The company gets together, and in November, December, they say we need to create a budget. So they'll create a budget at the end of the year for the next year. And they'll break out everything in different categories, and they'll break out their revenue, their projected revenue, and their cost of goods sold and their expenses, and they build out the budget, and they look at the bottom line, and they're like, ooh, okay, if we do this budget, we're going to earn 5%. So then what do they do next? They say, okay, well, that's not acceptable. We need to get it to 10%. So then they go and they either reduce their costs to an unrealistic level, or they just add more to revenue. And then they say, okay, we need to do $3 million this year, even though we did $2 million last year. Here's our budget. And they use the budget almost as like this semi-motivational tool, which is not really motivational, or almost like a control mechanism. Say, this is our budget. We're going to control our people by having them follow this financial plan. That's where it's broken, okay? So think about it. Customers control revenue. You don't control revenue. The only thing your company controls is cost. So when you're creating a budget and you're trying to create a control mechanism, it doesn't work because you lose control on the top line. Customers control revenue. You don't control it, okay? So instead, you need to change your focus to be more focused on forecasting. I want everybody on the webinar to have a rolling 12-month forecast. Okay, it's very, very important to have a 12-month forecast at all times. You have to be looking into the future. And when it comes to the actuals here, when you look at the profit, what I highlighted, $82,000 versus $124,000 in loss. This is what I was talking about in the past of how companies can have a profit and not have the cash flow, and they could go out of business. So it's very, very crucial to understand that you may have profit but not have the cash flow, and this is where forecasting comes in. Because if you can have forecasts that look into the future, then you can understand where the holes exist and how to plug it. So I've helped companies put together a 12-month rolling forecast. So when they look forward into April, they see, okay, we have a $50,000 hole that we need to plug, and then they could plug that with a line of credit or with profits rolled in from the previous year. So having a forward-looking forecasting tool is really key. Forecasting is not about controlling people. It's more about forecasting and trying to be more proactive into the future. Okay, so that's the point here. But the highest performing organizations, they focus more on effectiveness versus efficiency. Most companies, they compete on the left-hand side of this chart in the transactional compliance world. Okay, so they have an office manager typically or accounting person. They're doing the day-to-day data entry. They're entering invoices. They're billing customers. They're reconciling the bank account. Very transactional compliance type things. What I challenge you to do is move from the transactional side to be more strategic and more forecast oriented. This is really where you're going to be able to boost profitability, because you're going to be able to sit back and say, hey, what are my profits or my levers of profit? Oh yeah, pricing. And then taking the time to say, let's change our pricing a little bit. Let's see what's going to happen if I pull this lever, and you're more strategic in your thinking rather tactical and transactional. So I challenge you to try to change from the left-hand side to the right-hand side. So let's compare the old approach and the new approach. So the old approach, increasing targets, measures, and controls. That was the old approach. Setting targets for people, trying to motivate people through control. That doesn't really work. It's really about reducing targets and measures and controls. And it's about improving your business analysis skills. That's probably the number one thing companies can do, is improving their business analysis skills to boost profitability. I mean, let's face it. All of you who are in business or working for a landscape company, you probably have the technical skills. That's why you're in business, and that's why you're successful at the execution and operations. But so many people lack the business skills, and that's not a bad thing. It's just you have to be able to strengthen both pieces. Okay, so eliminating costs that don't add value. It's about measuring, learning, and improving. I always say build, measure, learn. Build, measure, and learn. Build, measure, and learn. Right? Each part of your business, build on it, measure it, and learn. Build, measure, learn, and repeat. So that's, you can look at this chart here, but this is the switch here. But when it comes down to it, remember, you must take a holistic approach to boosting profitability. If you just focus on profit solely and you ignore other parts, employees are going to leave. You're not going to attract the right talent. Your products are going to go bad. Your products and service quality is going to go down. You're not going to have the right plan in place, and you're not going to deliver value to the customer, who's at the center of the triangle. So how do we become more financially minded? Let's talk about some different considerations. First of all, capabilities. Does your company have a strong understanding of the financial statements? Okay, can they produce a statement of cash flows? Can they create a balance sheet? Can they create an income statement? And can they read it and interpret the story behind the numbers and make changes? If not, are you investing in that training? Okay. Estimating and pricing. Are you using the right approach? Do you have the right pricing strategy that incorporates customer demand, seasonality, and backlog? Do you have the right tool, right? That's the technology down below, but do you have the right estimating tool? I said this last week in the emerging technology thing, but I'll tell you, there's estimating tools out there in the landscape. There's a lot of different tools in our industry, but some of the tools are nuanced in a way that you will not know until you actually.
They've spent thousands of dollars implementing software, estimating software that have low barriers to entry. We'll say that, right? No, not a lot of upfront cost, and just very low monthly fee type platforms, and they're lured in by that. But what they don't realize is that low fee is actually really expensive, because after they go through and they build these different templates or kits or whatever you want to call it, right? These different modules. Over time, they realize, oh dang, there's different things that make the software very, very difficult to use, and very difficult to get my team to use and incorporate. So be very, very wary of that, because that can definitely kill you. I mean, the Dynascape software, I don't work for Dynascape. I don't really have any loyalties to them, so I could talk independently and not get punished. But I'll tell you, I've helped companies incorporate their software, and definitely night and day difference. I mean, you want to talk about ease of use? That's definitely key. So be aware of that. I say that because it always breaks my heart when I talk with a company and they spent $20,000, right, in time outside of software, but time building estimating programs that do not work. Forecasting. Make sure you have a rolling 12-month forecast. That's key. Okay. Make sure that it feeds into your estimating and your management software. You're updating your pricing and you're estimating accordingly. Financial reviews. Make sure that you're looking at the right financial statements. Statement of cash flows, number 1. Balance sheet, number 2. Income statement, number 3. And then technology. Are you using the right technology that streamlines design, estimating, and profit? Got one more webinar coming at you next week, and I'm going to be talking about strategies during that one. But hopefully you start getting the bigger picture. This idea of strategic financial leadership, being innovative to adopt the right technologies, to be cutting edge, financially minded, to understand what levers you can pull and what instruments to pay attention to make sure that your landscaping company is thriving, right? And then what kind of strategies do you need to win in your marketplace? There's a lot of things that are thrown at you. The big thing is, think big, have a big vision, start small, and act quickly. Stop talking about things, right? Stop talking about one day we're going to do this, and start now. Start small, but act quickly. There's on the next slide there, there's a lot of people ask, what else can I do when I don't put stuff on there? People berate me and they give me lower ratings because they're like, tell us more. And then when I put stuff on there of what we do in other products and offerings, and some people hate me because they say, oh, you're being self-promotional. So it's damned if I do, damned if I don't. But I'll just mention this. There are other things out there. We put on a thing called Strategic Financial Leadership, and I think it's a great program for people in the landscape industry to really beef up their skills on the business side. And if it's not this program, there's other programs out there as well. But that's just my challenge. Just be a bold leader and think about things differently in your business. Be smart, right? Landscaping is a tough business to run, so be smart and maximize your returns if you're going to do it. And that's I'll leave off with that. And if there's any questions or any comments, Joe, you could take over from here.
Great.
Kind of wrap up.
Yeah, thanks, Steve. And the strategic financial leadership program that Steve runs is something that he and I are talking about bringing to the Dynascape community. So keep that in the back of your pocket. We may be looking at putting something like that together for the winter for the Dynascape community. So stay tuned for more on that as we work out some of the details. Steve, there are a couple of questions that have come up. What might you have, as a self-proclaimed financial nerd, what might you have? What might you tell other landscape business owners to bring out their own financial nerd?
Yeah, I think it's a great question. I think it's understanding the basics first, right? It's the biggest thing is the question that I'd ask you is, if I gave you the three financial statements I was talking about, the cash flow statement, balance sheet, and income statement, could you read those? Yes, you can read them and you can do the math and you can tell me how the numbers work. But can you tell me the story behind that? And if you can't, then you need to strengthen that. So there's books out there if you like reading. There's you could take online courses. There might be like a Coursera online course that you could take, but you could do like an in-person course like I mentioned. But there's a lot of resources out there. I think the key thing is just finding the right person that can teach you in a way that you'll understand, right? So, but that's how you can learn it out.
Cool.
Look online, look on YouTube, get a book, go to a course, be involved in a program, but definitely invest in this area. Great question.
Thanks, Steve. So one other really important question, and someone had asked this earlier on in the webinar. When you're talking about increasing the price, having the biggest payoff for profitability, I think was almost 20% by increasing your price by 1%. How in the heck do you do that in a market where competition is extremely high and the competition almost all the time is based on price?
Yep. So great question. Sometimes, let's face it, you can't. If you're in a super price sensitive market, let's just say you are in a commercial maintenance business, right, where margins are so thin and competition is so intense, you may not be able to use that lever and you have to rely on the other levers. But what I'd challenge you is that if you can focus on your strategy, if you could really determine what's truly unique to your business and you can communicate that clearly to your customers and create value for them, then that's where you can increase price. You can't just go and increase price just to increase price. But if you could go in and increase value and demonstrate that in a clear way, that's where you can boost your price. So it really comes down to market focus, what markets you're focusing on, and your positioning within that market. So I know that's kind of a big question, but that's where it comes down to strategy.
Yeah, I think strategy is completely part of it, right? Adding the value and helping your potential client know what that value is, and selling them on what you're bringing to the table.
Exactly. I mean, think about Dynascape real quick. If Dynascape came back to its customers and said, "Okay, guys, just to let you know, we're not going to release any new features for the next 5 years, and we're raising our price by $3,000," people would say, "What?
Yeah,
that doesn't make sense." But if the company is constantly adding value, right? If they're, here's a new feature, now you could color render plans. Oh, here's a new feature in Manage 360. Here's a new feature here, and they're constantly adding value. If they're not charging more, that's a great company because they're constantly adding value. And if the price goes up a little bit, then you say, yeah, the price went up $30. That's no big deal. Look at all the value that I got. So when value exceeds price, customers buy.
100%. Hey, everybody. Join us next week. Part 3 strategies to survive the cyclical nature of the landscape industry. Next week, same time, 1:30 p.m. Eastern Standard, Thursday, September 21st. It'll be the final installment in the three-part webinar series with Steve Coffern and his great organization, the Cultivar Group. Steve, despite our technical difficulties today, I think it was a really great webinar, helping us understand the statement of cash flow and what free cash flow means. I think that's a huge takeaway for everyone in this. It's definitely one of those financial statements that most people just don't look at. And like you said, it's what happens, but it's not acceptable. And so I think for everyone, our takeaway is to go and be really, really familiar with the statement of what the statement of cash flow is and what it means and how it can impact what you do on a daily basis. Our reach wouldn't have been possible without the great help from these organizations, excellent help from our promotional partners. So really appreciate all the help that all these great organizations did to help get the word out. And join us next week. I'm Joe Salemi, Product Marketing Manager with Dynascape Software. My contact information is here. Please feel free to reach out. Let me know what you thought of today's webinar. I will be sending out this recording later today, so you will be able to review it and really get into detail and review what Steve had to say about all the great ways that we can understand our finances in the landscape business. Steve, thanks again for your great work, your great expertise. Really appreciated your time today.
Great. Thank you, Joe, and see you everybody next week.
See you next week.